Domo technically tripped a minimum recurring revenue covenant this quarter, which means over $130 million of debt is suddenly due right now. But they also completely canceled their earnings Q&A because they're in, quote, advanced buyout talks. So it is an incredibly dramatic Monday. Welcome to Earnings Unscripted. Today is June 15th, 2026, and we are unpacking Domo, ticker DOMO, and their Q1 2027 numbers.
Yeah, the classic ignore the balance sheet, look at the lawyer's maneuver. When a company pulls the analyst Q&A entirely, it sends a very specific signal. Their singular focus is just closing a transaction before the lender runs out of patience.
Right. And since things are moving so fast on this one, quick reminder that we are just sharing facts and our personal opinions here, definitely not financial advice. So, Miro, looking at the actual top line, things were slightly down. Total revenue came in at $79.4 million, just down 1% year over year. EPS was a loss of 33 cents, but that actually narrowed from the negative 45 cents last year. So what are you seeing under the hood?
It's the subscription revenue that's the tell. That dropped 2%. $269.8 million. But they are aggressively shifting to a consumption-based pricing model for their AI tools. You know, they build these applied analytics and AI agents for operational networks.
Oh, right. Like that use case from the call. A massive media company used Domo AI agents to monitor a live sports broadcast stream, automatically pinging the network team if a feed even glitched, which is genuinely a cool application of the tech.
Exactly. The product itself works. If you look at customers who migrated to that new consumption pricing model, their net retention is staggering. It's roughly 108%.
Wow, okay.
The problem is aggregate net retention across the whole company is only 95.5%. So the new model is highly sticky, but the bulk of the legacy base is dragging on the financials. We should also highlight they are cutting costs. Non-GAAP operating margin was a positive 6%, which is a 400 basis point jump year over year.
Got it, which probably helped steady the nerves after a pretty brutal period. The stock lost over 40% this past quarter. Then earnings dropped, and we saw just extreme volatility in after-hours trading. It dived hard initially, but then actually climbed back up to finish the post-earnings reaction up 4.3% compared to the prior close.
Because nobody's trading this stock on fundamental operating margins anymore. Investors are pricing the buyout. They saw the forbearance agreement with the lender. They know the clock is ticking. So the market is strictly betting on a takeover premium at this point, not a long-term operational turnaround.
Which makes it the perfect setup to look a little deeper. All right, let's get into the details on this debt covenant situation and figure out what forced their hand.
Right. So the mechanics here are actually a bit tragic if you look at the timeline. They tripped a minimum ARR covenant, annual recurring revenue. But they didn't trip it because clients are fleeing. They tripped it because of their own pricing transition.
Oh, the consumption model shift you mentioned earlier.
Exactly. When you move legacy clients from a flat subscription over to usage-based billing, you get this temporary revenue valley. Management literally called it a J-curve drag on the call. The recognized ARR temporarily drops while the actual customer usage is still building up. So operationally, it is probably the right move. But financially, the lender's contract just says, you missed the target number. Pay us now.
Geez, that is incredibly painful. So they do this smart strategic thing for the product, and the paperwork basically gives them a $137 million heart attack?
Pretty much. And because of standard GAAP accounting rules, all that long-term debt instantly becomes current. It is due immediately, which is why they are currently surviving on that signed forbearance agreement. The lender's basically saying, we won't liquidate you today, but you are on a very short leash.
Sure, except you don't cancel your entire earnings Q&A just because of a forbearance agreement. There has to be something more concrete behind the blackout to silence the executives like that.
There is, and it is buried deep in the footnotes of the 8K. I was digging into the general and administrative expenses, and they quietly recorded almost $500,000 in executive officer severance this quarter. $488,000 to be exact.
Wait, they paid out a massive severance to cut an executive right before announcing advanced M&A talks.
Or the potential acquirer said, we won't need this specific seat filled when we buy you. I mean, it is classic pre-merger house cleaning. You do not dump a C-suite executive and hand them $500,000 when your liquidity is completely frozen unless somebody else is driving the bus.
Okay, you are very cynical, but that actually makes perfect sense. If a private equity firm or a strategic buyer is swooping in, they're definitely looking at redundant headcount. So this buyout isn't just a vague hope, it is very much in motion.
Look at the warrant liability line, too. The remeasurement expense doubled year over year. Hit $2.1 million this quarter. Warrants are getting actively repriced right now. Lenders see the buyout coming and they are calculating their upside. The whole capitalization table is basically bracing for a transaction.
Which perfectly explains why the lawyers locked the doors. The CEO explicitly said the goal is to announce a final transaction in the near term. So they just put their pens down and shut off the microphones to avoid saying anything legally binding. Let's actually take a step back, though. What does this mean for the company's trajectory right now, or even for anyone trying to model next quarter?
Well, you can't. You can't model it. They completely suspended all guidance for next quarter. The CFO came on the call and explicitly said, quote, "Given the advanced stage of our strategic discussions, we will not be providing financial guidance." So if you were trying to project the rest of the year, you were basically flying blind.
Jeez. So retail investors and analysts they are flipping a coin right now. Heads, a white knight buys them at a decent premium. Tails, that forbearance agreement runs out and the lender takes the keys. That is a terrifying binary bet to be holding.
It is. But look, step back from the buyout drama for a second. There is a broader lesson here about the modern tech cycle. The underlying shift they made to consumption pricing, it is exactly where the enterprise software industry needs to go.
Oh, absolutely, because it actually rewards real utility instead of just forcing people to buy dead seat licenses.
Right, except you do not try to cross that revenue desert when you have strict debt covenants locking up your balance sheet. I mean, they essentially decided to rebuild the airplane engine in midair.
And then the lender just turned off the fuel, which is honestly such a shame because their core vision is spot on. I think the CEO had this quote. Let me find it. Yeah, he said, "We are in the early innings of a major shift from AI experimentation to AI embedded in everyday work."
And he's entirely right. But the tragic irony is that someone else gets to cash in on that vision. Some private equity firm is going to scoop up a highly functional AI engine at a distressed discount just because the capitalization table caught fire.
Which is the most classic Wall Street ending imaginable. Great product, wrong capital structure. Well, I suppose all we can do now is wait for the M&A press release.
Assuming the lawyers ever let him speak again, yes.
Always a pleasure, Miro. See you next quarter.
And just a quick final note, if you want these earnings breakdowns to show up automatically, definitely make sure you follow the show. Also, as a little transparency aside, while this exact conversation is generated using AI, every single metric we referenced is pulled directly from real company filings. We genuinely love hearing what you want us to dig into next, so feel free to shoot your ticker requests over to earningsunscripted@datamadness.ca. Thanks so much for listening, everyone.